Hey, it's Jason here, and I wanted to do a 2022 video talking about really the key takeaways I would put forth as far as buying businesses in this new year in 2022. Couple of big updates and really key takeaways I think you have to be thinking about. Number one is the potentiality for interest rates to go up in this upcoming year. It's pretty likely, if you're paying attention to the Fed, Jerome Powell, and the like, that interest rates will be going up. Secondly, you really have to be talking about and thinking about inflation and if that inflationary trend is going to continue to persist or if the increasing of the interest rates is going to curb that. We would want to be talking a little bit more in this video about the SBA, some of the changes and policies that are going on there as far as financing business acquisitions in that $1 to $5 million range. Wanted to talk a little bit about the labor market and the changing in costs as it relates to business in prior years relative to upcoming years, and how you should underwrite deals. When you're analyzing deals, you're getting financials in, you're getting P&Ls in, balance sheets in, tax returns. How do you look at those financial statements and understand which of those expenses should be increased versus which of those expenses should be fixed? So I wanted to talk about those items. But first thing, interest rates likely to be increasing. I would expect, and I'm not a professional economist, right? I'm just a business owner, somebody who is actively looking to grow our business and who is always exploring other opportunities for M&A growth, business buying growth, right? So that's who I am. But I would say that there is a legitimate chance that interest rates could go up between 0.75% all the way up to a whole percent or even 1.5% in 2022. I think that's fair to say. Quantitative easing, it looks like will be stopping, and then they're going to turn the rates up, right? They're going to turn the rates up, the Fed will, and I think that will happen at multiple points throughout 2022, right? I think the first time they may do it will probably be at the end of Q1, probably again towards the end of Q2, depending on how inflation is or is not reacting to those interest rate hikes. I think there's the chance for more more interest rate increases in Q3 and then once again in Q4 of 2022. So that is something I would really be looking out for. So as far as the cost of capital with regards to, say, bank finance, I think it's fair to say that when you run your financial model and analyze how much it's going to cost to repay the debt to buy a business using bank finance or any form of finance with interest rates, expect that you're going to be paying more if you close your deal towards the back end of 22 versus closing it in the front end of 2022. Likewise, if you're negotiating with a lender and they provide you a term sheet with a variable rate, again, you got to write into your deal that there may be a 1 to even 3% increase in your rates over the next 12 to 24 months. I think there's a chance that rates continue to increase all the way into 2023. Can't guarantee it, certainly. It'll be interesting to see once the Fed increases rates once or twice what happens with regards to inflation, and that's really the reason why the Fed is flirting around with the idea of increasing rates. It's because of things like inflation, and so that's something to really keep in mind. And I think now is a good time to look for that fixed rate option or to really underwrite your deal such that there's plenty of free cash flow if you're going to do a variable rate, so that if the Fed does increase rates and you do have your interest, say, go from 6% to 8%, that there's plenty of free cash flow from your deal to cover that increase in debt cost, right? You got to be mindful of what can happen as far as your monthly debt load if rates go up considerably. And this is where you have to play with the loan calculator. I mean, just a good exercise in general for anybody who's looking to buy businesses. One, go to the case study videos we've done here on the channel, and I've done a couple of videos here on the YouTube channel where I show the cost of capital and show if you're buying a business for $1 million and 800,000 of it is coming in the first position debt, and then another 100,000 is in a seller second position note, and then there's 100,000 in, say, equity that's invested. Just play around with the cost of capital on a 10-year fully amortizing term versus a 15-year fully amortizing term versus a 20 or a 25-year fully amortizing term. You're not going to get 15 or usually 20 or 25-year terms in business buying. You will more so in real estate. Real estate v. business, a lot of differences as far as how you're going to finance those deals. But in any event, play around with amortization rates or amortization schedules rather. Play around with interest rates. Play around with a mortgage calculator or a commercial loan calculator so that you understand how the changing of rates, how the changing of terms and amortization schedules will influence your cost of capital when buying a business, right? So You got to be mindful of what is going to happen with interest rates. You have to be mindful of inflation and the fact that inflation is really what's causing these interest rates. And then you have to then be mindful of what are those influences, or those factors, I should say. What are those factors going to do to the asking price of businesses and then the actual transaction price where businesses are selling at, right? So every single market has its own micro market, if you will, right? So, buying service-based businesses is different than buying SaaS, software as a service business, or buying tech-based businesses, right? Those are very different types of businesses, pretty obviously. Notwithstanding, buying a $1 million service business is going to be very different than buying a $50 million service business. Same if you're buying software as a service, SaaS businesses, right? A $2 million SaaS business is very different than buying a $100 million SaaS business. How many times earnings are you buying a $100 million SaaS business versus a $2 million SaaS business? Same in service. If you're just buying, say, like in my world, I buy plumbing and HVAC businesses. How much does a $500,000 plumbing and HVAC business pay as far as the earnings multiple versus a $25 million service-based business? Very different, right? And what I think you can expect is that prices will inversely correlate with how much the rates increase, right? So I think the more interest rates increase, the lower the purchase price will be as it relates to the earnings multiple, right? So in business buying, and if you're totally new to this, I would go to my business buyer's guide, like the beginner's guide. I've made videos like that here on YouTube. But normally when you're buying a business, you're buying a business at an earnings multiple. So say, for example, a business does $500,000 to the bottom line a year, as defined as EBITDA, earnings before interest, taxes, depreciation, and amortization, or owner's benefit, which is basically the earnings plus how much the owner pays himself, or sometimes it's also called SDE, seller's discretionary earnings. You can Google these terms and learn more about them. But in any event, you're usually going to be buying businesses based on multiplying, say, EBITDA by 2 or 3 or 4 or 5 or 6 times EBITDA, 4 or 5 or 3 or 6 times earnings, right? And what I think you'll see is as rates increase, you will be buying businesses at lower multiples. That's my prediction. It's pretty standard par for the course. If you study history, that's generally what happens. The lower rates are, the higher asset values are. Once rates go up, asset values go down. And so I think what you may see as well, tying into this point, is there may be a lot of sellers that come to the market in the next several months. As sellers of businesses, if they're kind of at that point where they're thinking about selling, they may be thinking to themselves, man, rates are about to go up. It probably makes sense for me to cash out my chips now as opposed to in 2 or 3 years from now when interest rates might be 200 or 300 basis points higher than they are now, right? At 2 or 3% more than they are now, right? So I think what you may see is a lot of businesses that go onto the market, or sellers who become sellers, right? Owners who become sellers in the next 3 to 6 months, right? The first half of 2022. And depending on the perception business owners have about the likelihood of interest rates to continue to increase or not, I think will impact how motivated sellers get and how many motivated sellers there are and become to cash out and get out of their business before those rates go up, right? Because from the buy side perspective, of course, as interest rates go up, your cost to buy the business goes up at the same purchase price, right? Taking out $1 million loan on a 10-year fully amortizing term at 6% is very different than at 9%. Very different. I mean, you're talking about many, many, many hundreds of dollars, and I'd have to run the exact math on it, but my guess is it's probably an extra 1,000 or more every single month that you're looking at if the interest rate goes from 6% to 9%, right? And this is why you have to play with a commercial loan calculator to understand these items. But I mean, your interest rate increasing is substantial. It gets more substantial when you get into the 15 and 20-year terms, or 15 to 20 year fully amortizing terms, or really the amortization schedule in particular, right? How the loan is being amortized. If these are foreign terms for you, do some homework on my YouTube channel and do some homework on Google to understand, and again, play around with the loan calculator. One of the best ways to understand how loans work is to just go to 10 years, go to 20 years, understand the difference between a term versus an amortization schedule. These things matter if you're going to be buying businesses. You have to be able to speak up this stuff fluidly and understand what they mean, what the mechanics of these different factors influencing loans. How do they influence how much you actually pay? But these potential interest rate increases, I think, will lead to owners wanting to sell before the rates really go up, And then as rates go up, I think business owners will be getting less for their businesses than they might have been getting in, say, 2021 when rates have been, very, very low. So that's something I would be on the lookout for as well. Wanting to now shift gears a little bit as far as underwriting your deals, as far as the P&Ls and the tax returns themselves, a couple of things to think about. Number one is that I really think you're going to see in 2022 and in 2023 that materials costs are way higher than they were certainly in 2020. 2021, you saw inflation continue with regards to a lot of raw materials and raw goods, all of the materials that lead to production of things. And so I think what you're going to see is your material burden or your cost of goods sold is going to be a lot higher in 2022 than it was certainly in 2020. And the second half of 2021, it got a lot tougher than the first half of 2021. I mean, in our business, we saw our cost of materials go way up in 2021, and obviously I think that's going to persist. We're seeing by and large that a lot of these raw materials, the pricing went up and it stayed up. And this is, by the way, why the Fed is increasing interest rates, because for a while they were saying, hey, these inflationary costs are transitory, and by Q3 and then Q4 here of 2022, or excuse me, of 2021, by the end of 2021, Jerome Powell and co. in the Fed realized, oh wow, these rate increases aren't transitory. I'm sorry, I'm getting my words mixed up. These inflationary costs are not transitory. It's still a lot more expensive to get plastic or copper or all of these raw materials that go into the manufacturing of things. Wow, all these raw costs are way up. They're not going down. This inflation seems to be persistent, right? And I think that's going to continue. All indications are that it's going to continue on the raw material side. And equally, I think on the labor side, we're not seeing any signs that labor is going to become more cheap. In other words, workers and employees in almost any industry have gotten considerably more money for their craft, for their skill, for their work, for their labor than they did in prior years. I mean, you saw labor rates increase a lot from 2020 until now in 2022. I mean, probably upwards of 7 to 20% in some industries was the increase that a lot of employees were able to negotiate. I know we have a federal minimum wage, I believe at the time of filming this video, of I think like $7.50. But as an employer, somebody who has about 45 people on payroll here in Tampa Bay, I mean, I can tell you, nobody in their right mind would even think about going to work for $7.25, much less $10. I mean, a starting wage at the beginning of 2022 is really $15 an hour. I mean, somebody with no skill, not even a driver's license, where they can't even drive a company vehicle, like basic, just, hey, it's a body who's willing to show up. At this point, that's pretty much $15 an hour, close to. It's a little different for administrative because you're in an air-conditioned office, and so there you might be able to get 12, 13, 14 a little bit more easily because, you're in an office. And of course, if you have benefits to your company, if your company's offering benefits, that influences things as well. You're giving paid time off, you're giving PTO, paid time off, you're giving vacation pay or holiday pay. You have health and vision and dental insurance. Maybe you have a retirement package. You have some of these other perks. Maybe you give somebody a company car. Employees are being more mindful of, the perks of employment. It's more difficult now to get people to come onto your company than it was in the past. In the past, you could fire somebody. I mean, ask old guard business owners who operated businesses in the 70s or the 80s or the 90s or even the 2000s. In the old days, it was, you could fire someone and you have a line of 5 other people waiting to get in their spot. Having a job used to be a coveted thing. Now an employee can, flip off their employer and be hired the next day and get a pay raise in many cases. So I think it's making employers have to be more mindful of, perks and benefits and taking care of their employees. Also, I mean, there's a lot more recruiting costs. I mean, we personally in our business, we spend a lot of money in recruiting costs, being in front of potential employees and being able to recruit employees to come sit down for an interview. I mean, it costs money to get people to sit down at my office and to talk about working, with ourselves and with B&B in my case, with my company. And so, I think if you look at recruiting costs that a business had in 2019 or 2020, it's going to be very different than it will be in 2022 and in 2023. A lot of people came out of the labor force in 2021. They don't want to get back in the labor force. It, motivated a lot of people to take an early retirement because of health risks, and they just didn't want to deal with COVID and all of this stuff that's going on. So I think you have to be aware that your cost of materials are going to be way up relative to historical years. Your cost of labor is going to be way up. I mean, looking at a 2018 or a 2019 P&L, it's just going to be totally, those existing costs are going to be so different than the costs you're going to experience in 2022. And that's really the big takeaway is, in my opinion, to underwrite a deal successfully in this day and age, you need to rebuild your P&L from stem to sternum. From top to bottom. You really, in my opinion, you have to rebuild that P&L and you have to rebuild the P&L taking the true cost of things in the 2022 marketplace and then project potential increases in 2023 and in 2024. Another one that's gone way up is commercial auto. Commercial auto policies have gone way up. If you talk to an insurance broker, for those of you who are in business already, here in the state of Florida, for example, commercial auto has gone way up because you got all these quote unquote ambulance chasers for lawyers who are filing claims and they're going after your GL or going after your umbrella policy. The lawyers are, and the plaintiffs are. And so there's just a lot of these business expenses that have gone way up. So you can't underwrite your deals using 2018 and 2019 numbers. You can. Of course you can. You can do whatever you want. You can't accurately, there's the key word, you cannot accurately underwrite your deals, in 2022 with 2022's expectations using 2018 and 2019 inputs. You've heard the phrase garbage in, garbage out, right? And so that's really the punchline is you need to get updated quotes, updated pricing, whether it's materials cost, your true cost of labor now in this day and age, whether it's insurance. From stem to sternum, from top to bottom, kit and caboodle, pretty much across the board, costs have gone up. And of course, what business owners have done is they've passed on these incurred costs to customers, which is what's created the inflation. You kind of see how we're going full circle here. So anyways, that's really what's going on. You can expect that you as a business owner, if you're buying a business in 2022, you will be charging customers more than I'm sure the prior business owner was charging in say 2018 or 2019. So it's both ways. Your revenue should be going up even if you're doing the same amount of sales as you were in years prior, but also your costs are going to go up. So you have to underwrite your deal with this new mentality of the new world pricing as we have it here in 2022. All right, so those are the main things I'd be thinking about. I'll also quickly mention the SBA. The SBA is down from the 90% guarantee to the 75% guarantee here in 2022. That's likely to persist, I think, for the entirety of 2022. And so what that really means is I think the best way to buy a business here in 2022 is to basically do about 75% of the purchase price in a first position SBA loan, to bring about 10% equity to the deal, 5% of which should be cash, has to be cash for you to do an SBA deal. The other 5% put on hold for the life of the first position seller finance note, for the life of the first position SBA note. So let me say that again to make sure we have clarity. About 75% of the purchase price, SBA, okay? 5% do seller hold equity for the life of the first position SBA note, right? So that's where the seller literally doesn't get paid on 5% of the purchase price until you entirely pay off your SBA loan. I've done other videos talking about SBA finance, and I've described this construct at length. But really then the remaining part of that purchase price, about that 15 or 20%, that final 15 or 20%, you have the 5% on hold for the life of the note. You got about 75% from the first position SBA loan. And that gives you about 20% that's left over. Of that 20%, 5% is going to have to be in cash. So now you have about 15% left. That other 15% I would put in a traditional second position seller finance note, maybe 10 years, fully amortized at 7%. And that's really about how I would do it. So you're looking at, sorry, my camera turned off there. So what I would be looking at is, say, $1 million deal. The SBA is going to give that seller $750,000 cash. Okay, you're then going to add an extra $50,000 in cash to be the 5% of the purchase price that qualifies as the cash injection. Okay, so now you're up to $800,000, 80% of the purchase price that's going to be paid at cash at the closing table. That final 20% I would have is seller finance to keep the seller engaged and to ensure that the seller's not selling you a snaky business. Of that seller finance, 15% of the purchase price, in my opinion, I'd put, and this is roughly speaking, but this is kind of what I would do. About 15% of the purchase price I would have fully amortized over, say, 10 or 15 years at, say, 7% interest or 8% interest. If you can get it lower, great. The interest rate, great. And then the final 5% of the purchase price, I would put on hold for the life of the first position SBA note. I've talked about this in other videos, but basically by having that 5% on hold for the life, you then only have to bring 5% of the purchase price to the down payment, and it's basically how you do closest thing to a no money down deal. And of course, you can do a no money down deal by having that 5% come from an investor. Okay, and that's, again, stuff I've talked about in another video. I'm not going to go into the total mechanics of the SBA here, but that's how I'd finance a deal in 2022 if I was going to use the SBA. All right, if you want me to talk more about other ways to finance deals or other ways to buy companies, if you want me to talk about other things more deeply, drop in the comments below what you'd like me to talk about in the subsequent video. If you've liked this one, give it the old thumbs up. It helps the algorithm. And subscribe to the YouTube channel if you've not already. I talk about business buying and business operations, and I also talk about my story here as I've gone, as you can watch from my YouTube channel over the last 3 or so years, how I went from basically sleeping on my grandmother's couch to now, running a number of successful companies. And I'm continuing to grow, and we are continuing to grow. So it's a fun journey we're on here. So with all that being said, thanks for watching. I'll talk to you in the next one. Take care. Bye-bye.